Welcome to Alamut Capital Knowledge Center. When most people hear the phrase, financial planning, they think about one thing, retirement. They picture charts, projections, probabilities, and a single question, am I on track? But here's the problem. Life doesn't wait until retirement. And most financial stress doesn't show up at age 65. It shows up much earlier. Real life is layered. Families want to travel, upgrade homes, educate children, support parents, start businesses, take time off, and still feel financially secure. These aren't distractions from the plan. They are the plan. Yet in many financial strategies, these goals are treated as side notes instead of milestones. Traditional financial planning is usually built around one destination, retirement. Everything else is reverse engineered from that single endpoint. But when planning is built backward from one moment in time, something important is lost. Intention. Money becomes abstract. Goals compete with one another, and investments are often placed into generic portfolios with little connection to when money is needed or what it's meant to do. That's why many families feel like their plan looks good on paper, but doesn't feel right in real life. A major reason for this disconnect is how risk is traditionally defined. Most conversations focus on market risk, volatility, drawdowns, asset allocation. But for families, risk is much broader than markets. Risk isn't just about what happens to investments. It's about what happens to life goals if things don't go as planned. The first layer of risk is the risk to your goals. Income stability, expenses, time horizon, and how important each goal truly is. Some goals are foundational, others are flexible. Treating them the same creates imbalance. The second layer is your personal risk tolerance. Not just what you say you're comfortable with, but how you actually respond when uncertainty appears. Because even a well-designed plan fails if it can't be sustained emotionally. The third layer is the risk inside the investment portfolio itself, how assets behave across different economic environments, how much drawdown exists, and whether the portfolio aligns with when capital is needed, not just long-term averages. This is where many financial plans quietly break down. Risk is often evaluated in isolation, investment by investment, portfolio by portfolio. Something is labeled high risk or low risk, without asking a more important question. Risk relative to what? Imagine a family planning for three things at once. They need money for living expenses over the next 2 years. They want to fund education in 10 years. And they're building long-term security over 30 years. Now imagine evaluating every investment through the same risk lens. That's where problems begin. An investment that looks risky in isolation may actually be appropriate, even stabilizing, when matched with the right goal and time horizon. Growth-oriented investments may be inappropriate for near-term needs, but essential for long-term goals. When this distinction isn't made, families either take too much risk where they shouldn't, or too little risk where they can afford it. Both outcomes create stress, poor timing, and missed opportunities. When risk is integrated across goals, behavior, and portfolio structure, investments stop being judged in isolation. They're judged based on their role. Risk becomes contextual, not absolute. This matters more today than ever. Markets are more volatile. Economic regimes change faster, and one-size-fits-all portfolios are increasingly exposed. Planning and investing can no longer be treated as separate conversations. At Alamut Capital, we believe financial planning isn't about reaching a single destination. It's about supporting the entire journey. By integrating life goals, human behavior, and investment risk, we help families invest with intention and live with clarity, not just for retirement, but for life as it unfolds. Visit us at Alamut Capital and learn how we can truly make your life goals materialize through thoughtful and integrated planning.